Welcome to today's deep dive on whether you should sell your current home or convert it into a rental when moving. We'll unpack the promise of passive income, the harsh realities of landlording, and the impact on your financing for the next home. By the end, you'll have a clear, actionable framework to decide based on your priorities: simplicity and liquidity versus long-term, active wealth building. First, let's frame the decision. When you move for a better opportunity, you must decide whether to liquidate your equity by selling or keep the property as a rental. Selling offers immediate simplicity and liquidity. Renting promises potential wealth through appreciation and tenants paying down your mortgage, but it's an active endeavor with hidden costs and time demands. Next, here's our roadmap. We'll start with the landlord trap and why rentals are rarely passive. Then, we'll quantify the debt-to-income ratio consequences. After that, we'll compare selling versus renting head-to-head. We'll close with mitigation strategies, a quick calculator walkthrough, short quizzes, and actionable key takeaways. To visualize the choice, imagine two diverging paths. If you sell, you unlock equity immediately, making it easier to finance your next primary home and possibly redeploying funds into passive investments. Conversely, if you rent, you become an active investor. You gain potential benefits from appreciation and mortgage amortization, but you must manage repairs, vacancies, legal compliances, and tenant issues, incurring time and stress costs. Before we go further, an important note. This content is for educational purposes only and is not financial, tax, or legal advice. Every market, lender, and personal situation differs, so consult licensed professionals who can review your details before making a decision. Now let's address the landlord trap. Many underestimate the hands-on work and hidden costs. Property managers commonly charge about 10% of gross rent. And despite that, you still carry repair liabilities and other risks. You must budget for capital expenditures, including HVAC, roof, plumbing, appliances, and tenant turnover. If you live far away, you will either spend time coordinating vendors or pay higher fees for dependable management. Home warranties and service contracts can reduce volatility, but they do not remove risk. This decision map starts at moving to a new city and splits into two branches. The sell path highlights immediate equity, easier debt-to-income qualification, the ability to redeploy into passive assets, and minimal time commitment. The rent path emphasizes that lenders discount projected rent by roughly 30 to 40% for underwriting, includes management fees, vacancies, and repairs, and introduces legal and tenant complexities. A key decision checks whether net rent materially exceeds the mortgage. If yes, renting may be viable as an active investment. If not, selling likely offers superior peace of mind. Shifting to numbers. Lenders frequently discount projected rental income by 30 to 40% to account for vacancy and management. If the underwritten rent does not exceed your costs by a comfortable margin, your debt-to-income ratio can worsen, reducing the maximum loan amount for your next primary residence. For instance, with $2,500 in market rent, a 30% haircut leaves $1,750 as qualifying income. After taxes, insurance, and HOA, the loan officer may view the property as neutral at best, or a net liability at worst. To make this concrete, consider two scenarios using the same market rent of $2,500. In Scenario A, a 30% haircut reduces qualifying rent to $1,750. With total monthly housing costs of $2,100, the underwritten net is negative $350. In Scenario B, a 40% haircut reduces qualifying rent to $1,500. Resulting in a negative $600 underwritten net. These negatives increase your debt burden in the eyes of the lender and can reduce your borrowing power for the next home. Next, let's articulate the trade-off. Selling unlocks your equity and simplifies financing for your next home while enabling passive reinvestment. Renting can create long-term wealth through appreciation and amortization, yet it demands ongoing labor and entails volatility and risk. The crucial insight is that real estate investment is a job, not passive ownership. Only proceed if you accept the workload or are comfortable sacrificing a significant portion of profits to management fees. Now, compare side by side. Selling provides immediate liquidity, generally easier underwriting for your next mortgage, minimal time commitment, simple diversification into passive assets, and reduced legal exposure. Renting offers potential appreciation and amortization benefits, possible tax advantages, and tenants who contribute to paying down your mortgage. However, it requires active management or incurs management fees, and you assume risks from vacancies, repairs, and legal issues. This pie chart illustrates a realistic allocation of rental income. More than half often goes to principal and interest. Taxes and insurance consume another portion, while management typically takes about 10%. Repairs and capital expenditures require an additional reserve. Vacancy should be budgeted even during stable periods. The remaining slice, cash flow, is frequently much smaller than new investors expect. If you pursue renting, mitigate risk by building strong reserves, typically 5 to 10% of rent, set aside monthly for repairs and capital projects. Establish relationships with vetted vendors, and consider service contracts for major systems. Reduce vacancy risk by pricing competitively and screening tenants within fair housing requirements. Maintain clear documentation and compliant leases, and consult local legal counsel. If you live far away, hire reputable management and underwrite the full cost, including incidentals. This mind map places the decision at the center and branches into sell and rent implications. On the sell side, the emphasis is on liquidity, easier debt-to-income ratios, passive reinvestment options, minimal time demands, and reduced legal complexity. On the rent side, the focus is potential appreciation and amortization, possible tax advantages, management time or fees, exposure to vacancy and repairs, legal risk, and the fundamentally active nature of the investment. Let's operationalize your decision. First, estimate market rent using local comparables. Next, apply a 30 to 40% haircut to approximate lender underwriting. Then compute qualifying rent and subtract your principal and interest, property taxes, insurance, and any homeowners association dues. If the underwritten net is comfortably positive, renting may be viable. If it is negative or very slim, selling likely enhances peace of mind and eases financing for your next home. Quiz time. The question is, property managers typically charge what percentage of gross rent? Option A, 3 to 5%. Option B, around 10%. Option C, 15 to 20%. Option D, a flat monthly $50. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is approximately 10%. In many markets, management fees range from about 8 to 12% of gross rent. For simplicity, planning around 10% is reasonable. Second quiz. Lenders often discount projected rental income by how much for underwriting? Option A, 5 to 10%. Option B, 15 to 20%. And option C, 30 to 40%. Option D, 50 to 60%. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 30 to 40%. This haircut helps lenders account for potential vacancies, management costs, and general underwriting conservatism. For reference, here are useful formulas and a checklist. First, a simple net operating income estimate equals rent minus vacancy allowance, management, repairs and capital reserves, taxes, insurance, association dues, and utilities, if any. Second, underwriting rent can be approximated by rent multiplied by 1 minus the haircut, where the haircut is roughly 30 to 40%. Finally, use a checklist to confirm whether the underwritten net is positive, whether you have 3 to 6 months of expense reserves, whether you can manage or afford management, whether you are prepared for legal compliance and documentation, and whether renting restricts your next loan amount excessively. This timeline shows a possible 5-year arc. In year 0, expect turnover and make-ready costs. In year 1, the property stabilizes with a new tenant and minor repairs. In year 2, you may implement a modest rent increase but face an unexpected appliance failure. In year 3, a refinancing opportunity may arise if rates fall. In year 4, a vacancy month could necessitate a paint or carpet refresh. By year 5, you evaluate appreciation and equity to decide whether to continue holding or sell. In summary, renting is an active investment and should not be confused with passive income. Lenders commonly haircut projected rent by 30 to 40%, which can worsen debt-to-income ratios. If the underwritten net rent is not meaningfully positive, selling often provides better peace of mind. If you choose to rent, budget for management, vacancy, and capital expenditures with strong reserves. Most importantly, align your decision with your priorities, balancing simplicity and liquidity against the pursuit of long-term, active wealth. As we conclude, if you prioritize peace of mind and simple financing, Selling is often the superior path. If you are ready for active management and maintain robust reserves, renting can contribute to long-term wealth. Run the quick calculator before you contact your lender or agent and consult local professionals including a loan officer, CPA, attorney, and property manager to tailor the decision to your situation. If this helped, consider sharing it with someone facing the same choice. Before we wrap, if you found this valuable, please like the video, share it with someone making the same decision, and subscribe for more practical breakdowns. In the comments, tell us, are you team sell for sanity or team rent for wealth, and why? Your experiences can help the next viewer make a confident choice.